right, we're going to continue with the accounting cycle. We're going to work on adjustments when we do the worksheet, and we're going to adjust several accounts. The prepaid rent, the office supplies, depreciation, and we only have one in this chapter on equipment, and then accrued salaries. We're going to prepare the adjusted trial balance on the worksheet, and then we're going to do the income statement and the balance sheet on the worksheet. And then from the worksheet, we'll prepare the financial statements. I like the worksheet. I think it just puts everything in one place as you work towards completing the accounting cycle. We have completed number 1 up there with the business transactions. Remember, we need a source document for anything that occurs in the business. That could be a memo, it could be an email, it could be a bill, it could be a purchase order, anything that is, it could be a receipt, anything that causes something to happen in the business would be a source document. We've recorded entries in the journal, which is called the Book of Original Entry. That's in the journal. Then we learned how to post in the last chapter. You'll never get away from posting. It's probably the most time-consuming thing that you'll do in this class is the posting. From the posting, we prepared a trial balance, and that's just a run of all of the debits, all of the credits to make sure that we're in balance before we continue. Well, now we're going to put that trial balance in the first 2 columns on the worksheet. If you look in your book at a picture of the worksheet, you'll see that the first 2 columns say trial balance. It's just exactly what we did when we did it on the financial statement. Right? It's informal, it doesn't have any dollar signs on it, and it's the same with the worksheet. The next 2 columns on the worksheet are called adjustments, and we have to match income with revenue, or revenue and expenses in the same fiscal period. And some of our assets will need to turn into expenses, and we'll go through the 4 adjustments that we'll be working on in this chapter. After we do the adjustments, we have 2 more columns, and it's called the adjusted trial balance, just another opportunity to make sure that the debits and the credits equal. The last 4 columns, the first 2 will be the income statement, the last 2 are the balance sheet. And the worksheet will show our net income or net loss. From the worksheet, then we'll prepare the financial statements. Income statement first, statement of owner's equity, and then the balance sheet. And that's number 6. We've already done that in our other chapters, but now we're throwing in that blue area that says the worksheet. And note down below it says no worksheet needed if using an accounting software package. Yes, we'll do a little bit with Peachtree in here, and you'll see how much easier it is to do accounting when we use a computerized system. But we have to know what that computer system is doing, is why we're using paper and pencil. Why do we do the worksheet? Not all businesses will do the worksheet, and that was one of your questions. Do we have to do a worksheet? No, we don't. But it's used to organize and just make sure that our data is correct. It helps us to correct mistakes before we prepare the financial statements. It's thought of as just scrap paper. It's not an official document. And then it has all of those columns that I just went over. This is what it looks like. We just don't have the balance sheet over there on the right, because we have 2 more columns. The trial balance is just like we've been doing. Single line tells us that we've added or subtracted, and then the double line tells us that we have a total. It's everything listed in account number order. Now, you might have a few accounts that don't have a balance. And in some accounting classes, you'll list all of the accounts on the worksheet in the account number order. So you might have some accounts listed here that don't have a balance. If you want to list all of them, I don't have a problem with that. But in this book, if we list any account below the total on the trial balance, that account has an increased balance. It's just a way to help you, was that a debit or was that a credit when I did that adjusting entry? Because as we add the accounts down below, we know they had a zero balance when we prepared the trial balance. Now they have an increased balance, and it would be on their normal balance side. Right. Either way is fine. I think that the author of this book, Jeffrey Slater, just decided it makes these accounts stand out a little bit because they're down below the total. And we'll have to add some of those as we work through the adjustments. He has just listed the accounts that have a balance. And our debits and credits equal, don't they? All right, so we can go to the next phase of the worksheet. And where do we get those numbers? From the ledger. Okay, so we'll get them from the ledger. What steps have we done to get to those numbers? We journalized from the source documents. And we did something else that starts with a P. We posted. Right? Remember those 5 steps in posting, and you all promised me you would not write the account number down until the last step, so that you know where you left off with your posting. Why do we have to make adjustments? Well, the one account that we need to adjust is the prepaid rent. And when we paid the rent, we might have paid it for 4 months ahead. But if we show in January that we paid rent for 4 months, that doesn't really help us match our revenue and expenses for January, does it? If we show January, February, March, and April that we paid the rent in that 1 month. So we put that prepaid rent into the asset account called prepaid rent. And then as the month moves forward into the next month, then we will expense the portion of that prepaid rent that belongs with the month, and let's just say January. Then we'll expense that same amount for February, that same amount for March, and that same amount for April. When we looked at our concepts, and that was the sheet that I gave you with all of the concepts listed, we want to match revenue with expenses so we can compare January of this year with January of last year. Did our rent go up? Did we make more of net income than we did last January? And if we have all 4 of those months in January where we paid for the rent, it's not going to match up, is it? We won't have any rent for February, March, and April. So when we're adjusting that asset account, I always like to say that we're turning the asset into an expense. We're expensing the portion for that month. When we make those adjustments, we're going to bring those accounts up to date. That prepaid rent is going to go down, and the rent expense is going to go up for that month, January. We're going to recognize revenue and expenses in the proper accounting period because we want to be able to compare. Now, in this book, we do a lot of things by month, but some businesses may not compare January with January. They might compare 2012 with 2011, or depending on when they do their financial statements. Not every business will do things per month. Items that need to be adjusted, office supplies. Why do we need to adjust that? What we have left over. How would we determine what we have left over? We'd have to do an inventory, wouldn't we? Now, not all businesses, when they purchase supplies, put it into the asset account, office supplies. Some companies may automatically put it into office supplies expense. Right? This isn't the only way that you can do it. You just have to be consistent. If I didn't, and I don't know how we would ever count the supplies in this department, because I have supplies in my office, Mrs. Hahn has supplies in her office, we have supplies in the office of 307 for that big lab. How in the world would we ever count the inventory for supplies? So I would say when we purchase something, it's just expense. I've not really looked at the transaction here at SAC when we purchase something, but it's just automatically goes into supplies, and it would be an expense. You just have to be consistent. If you're the office manager, if you're the accountant, the bookkeeper in a firm, you just have to decide how you're going to do it and then be consistent. Did you have a question? Okay. And it might be easier just to put it in the expense account. Would you have to make an adjustment then if you did? No. And they have to tell us in our problem how many supplies we have left or how many supplies that we've used. When we make the adjustment, remember we're turning an asset into an expense. So the adjustment will be for the amount of supplies we used. And it's always for the amount used, not what we have left, because that will be the balance that moves over to the adjusted trial balance. The prepaid items such as rent, advertising, we can prepay insurance, you can prepay 6 months ahead on your insurance, and then we want to expense each individual amount so that it would match that amount. With equipment, if we're using depreciation, and why would we want to depreciate an asset?
Because some things like lose value, like a car goes and it wears down.
And it depreciates as soon as you drive it off of the lot at the new car place. It does. So it's not worth what you paid for it. Now we have a couple of different figures that we'll have to use when we determine how we're going to use depreciation. We just use the straight line depreciation in here, but there's lots of different ways that you can depreciate things. We're just using the easiest. Remember, this is intro to accounting. You'll get into more detail with the depreciation as you take some other accounting classes. So we're going to just use the easiest one. We will determine how much we paid for that item, and then that will stay on our balance sheet until we get rid of it. We don't ever change that amount. So if we paid $10,000 for a piece of equipment, it will stay on our book for $10,000 until we sell it. But each month, maybe, or let's say each year we're going to depreciate it $1,000 or $1,200. Let's make it a little bit easier. That's $100 a month, isn't it? And let's say we're going to depreciate it down to 0 for its useful life. I don't know that I'd want to take it down to 0, but if you know you're just going to trash it, at the end of 10 years you could do that. If we sell it at the end of its useful life and we make a profit, we have to report that as income. So you want to be as close to how much you think that item will be worth when you dispose of it. Accumulated depreciation keeps going up. Each month we're going to add $100. At the end of the year we'll have $1,200 in accumulated depreciation. If we subtract that amount from the amount of the equipment, we come up with what's called book value. That's the book value of that piece of equipment. So historical cost, the original cost of that item, minus the accumulated depreciation, will equal the book value of that item. And we'll do a couple of items that we're going to depreciate. I think the best story ever is one that my dad told me about 2 brothers. One had a coal mining business and the other one had a pig farm. And they had an airplane that they shared. And they would depreciate that airplane, because you can depreciate it, and then you can sell it, and then that person can start depreciating it. So the two brothers, the one that had the coal mine would keep the airplane until he depreciated it, and then he would sell it to his brother, and then his brother would depreciate it. Because what's the useful life of an airplane? Many years, isn't it? So they would just sell it back and forth to each other. They learned how to work the accounting system so that they could get the best write-off for that piece of equipment, that airplane. When we're depreciating, we're going to use an expense. And the expenses are what it costs to run your business. So they learned how to work the system, and I think that's a great example. So when we think about depreciation, think of the airplane story. With our expenses, the one adjusting entry that we'll do that will probably be the trickiest will be the salaries. And we'll just go with what they tell us in the book. If we have any accrued salaries that we need to make the adjustment for. Rent will be pretty straightforward, and supplies will be straightforward, and so will the accumulated depreciation. How to analyze and adjust the accounts. If our office supplies, if we purchase $600, and the inventory of supplies at the end of that fiscal period was 500, or 100, sorry, how much did we use in that period? We used 500. So we have to do a physical inventory of those supplies to come up with the fact that we just had $100 left. Now they'll give us all of that information in the problem, how much was left or how much we used. The supplies used will become the expense, so our adjustment will be for $500, the amount used. And that's what the adjusting entry is going to look like. We're going to be decreasing office supplies. We'll decrease it with a credit of 500, and we'll expense it with an increase to the supplies or office supplies expense. With our prepaid rent, paid rent 3 months in advance, $1,200. Each month would be worth $400. So each month we have used $400 of that $1,200. The rent used would become the expense. And again, they'll have to tell us how many months we paid for in advance and the amount. We'll have to do a little division if they don't tell us how much it was per month. Here's what the adjusting entry will look like. Prepaid rent, we're decreasing by $400. That leaves us a balance of $800, and we're expensing it into rent expense. Expenses have a normal balance on what side? On the debit side. So we've increased that rent expense. It probably had a 0. A couple chapters ago, we talked about temporary accounts. Temporary accounts are the ones that are on your income statement. Eventually, we're going to bring those accounts to a 0 at the end of the accounting cycle. We're going to close those so that each year we will start with a 0 amount in those expense accounts. And that's a couple chapters ahead. But we are going to eventually close all of those temporary accounts. The balance sheet accounts, which are the ALP accounts, they'll stay with us forever. They're permanent accounts. So the rent used with this adjusting entry becomes an expense. The word processing equipment, expected to help produce revenue. And we took the historical cost minus the residual value, what we think it might be worth when we trash it, and the estimated years that we'll be using it. So they gave us the example of $6,000. It will be worth $1,200. How do we know what it will be worth? Well, there's some guides, just like your blue book or the NADA book with a vehicle. How much will it be worth when you dispose of it? We'll have a guide that we can go by in this chapter or in this book. We'll just go by what they tell us. We think that it will last about 5 years, so that gives us $960 per year. If we're working on a monthly basis, well, we need to divide that $960 by 12, so we know how much it is per month. If we were just depreciating by the year, it would be the $960. So it's $80 a month. That depreciation is going to become an expense, and we never change that historical cost of that item. It will always stay on our books for what we purchased it for. Keep a running total of the depreciation taken, and here's just part of the balance sheet that shows the word processing equipment on our books for $6,000 less the accumulated depreciation of $80,000. What's the book value at the end of that first month for the word processing equipment? $5,920, and that's called the book value. They're also referring to it as the carrying value. When we start working on the balance sheet and we show the accumulated depreciation, that accumulated depreciation will go right underneath the equipment or the item that we're depreciating. It doesn't have to be the equipment. It could be a vehicle. Here's the one that's a little tricky. And for now, if you'll just take what they give us in our problems to make the adjusting entry for the salaries. But why do we have to make an adjustment? And if you were only making adjustments at the end of the year, would you even have to make this monthly adjustment? It says, let's assume that John is paid every Friday. The last week in May, Friday falls on June 1st. John's check will be written with the date June 1st. But May 28th, 29th, 30th, and 31st pay will be included in that check. We want to match revenue with the expenses. We're not doing that, are we, if we're putting those 4 days into June when they should be in May? On May the 31st, the adjusting entry will need to be made for the May amount that will be paid in June. Now, if we're doing this every month, and some of you may work in an office or a business right now, and you don't make that adjustment, in the end, by the end of the year, it probably all matches up, wouldn't it? But if you're looking at it by the month, it doesn't match up. Oh, I think I just advanced. So we have 4 days from May that we're paying in June. So in our situation, they'll have to tell us what that amount is. Now here's the real tricky part of this adjusting entry, is that at the beginning of the next accounting cycle, we're going to reverse this entry so that it makes it easier for us to pay the salaries when it comes time to pay it. Now the reversing of the adjusting entry gets a little tricky. Just do it if they tell you to reverse the entry. If you're working in a business and you have a procedure where you're always going to make this adjusting entry at the end of the month, for one employee, it's probably not a lot of money. But think about it for Alamo colleges. How much would those 4 days be worth? Quite a bit of money, wouldn't it? So we'd want to make that adjustment. If we're trying to compare January salaries or May salaries with June salaries, we want to make sure that we make that adjusting entry. Do they here? I don't know. I don't know whether they make that adjusting entry or not. We get paid on the 1st and the 15th. Does that eliminate having to make that adjusting entry?
No, you get paid on the first for the last half of the
we get paid on the 1st and the 15th. So that could be how they've gotten around making that adjusting entry. But if they tell us in our problem that we have some salary that was earned in the previous month and we're paying it in the next month, we need to make that adjusting entry. So here's the situation. Salaries accrued account. John worked May 28th, 29th, 30th, and 31st. This is $350 as an expense in May. Our adjusting entry puts it in office salaries expense for $350 and salaries payable for $350 on the credit side. What kind of an account is 212, the salaries payable? It's a liability account, so it's a promise that we're going to pay that eventually. Later on, when we make the reversing entry, we're going to debit salaries payable and credit salaries, office salaries expense. We'll just reverse what we did in the adjusting entry. Accrued salaries payable is credited until it's paid. And we'll pay it on June the 1st. That's probably the trickiest adjustment that we'll do. But notice the accounts that we're using. The liability account, the salaries payable, and then we're putting it under the office salaries expense. And the normal balance for the expense account is on the debit side. When we make our adjustments, and you can see the next two columns, we did not have some of those accounts listed on the trial balance. So when we look at adjusting entry labeled A, which was for the office supplies, our debit for the A was office supplies expense, and our credit was office supplies. The B adjustment, the debit is rent expense, and we didn't have a balance in rent expense when we started with the trial balance. That's our debit, and our credit is going to be prepaid rent. How will we get the new balance for the prepaid rent? What will we have to do? We have a debit, and then we have a credit entry. We'll have to subtract. The C adjustment was the depreciation. We have on the C for the debit, depreciation expense, word processing equipment, and then our credit was accumulated depreciation, word processing equipment. Neither one of those accounts were listed in the trial balance. Remember, any account that we list below the total has an increased balance because it had to have a 0 when we did the trial balance. Does that seem easier to do? Maybe. You'll have to decide whether you want to list all of the accounts, and that's perfectly fine when you do the trial balance, even the ones that don't have a balance. Or do it this way, and then that will help you determine, is that a debit or is that a credit? The last one is the D. Our debit was office salaries expense, and we had a balance in that account, so it's already up there. So check to see if you have it in the trial balance before you list it below. And then the credit was salaries payable. We have 4. They're labeled A, B, C, D. And then we total those two columns to make sure that our debits and credits equal. It looks like they do, don't they? Okay, so we're ready to move on to the next two columns, which is the adjusted trial balance. The adjusted trial balance, which is the next two columns, it just gives us one more chance to make sure that our debits and credits equal. The numbers are totaled from the trial balance and the adjustments. We might have to subtract. We might have to add. 2 debits, we'd add them together. A debit and a credit, we'd have to subtract. A credit and a credit, we'd have to add together. So let's look at the adjusted trial balance, and we're just carrying all of those numbers over to the adjusted trial balance from the trial balance and from the adjustments. So cash didn't change, did it? Accounts receivable didn't change. Office supplies did. We had $600 on the debit side, and then we have a transaction in the adjustments for $500 on the credit side. we'll have to subtract. What's our ending balance then for the office supplies? $100. All right, let's go down to the next one, prepaid rent. That one we know should go down because we paid $1,200 for 3 months. And we made the adjustment with the B, $400. How much prepaid rent do we have left? $800, right? Word processing equipment, remember it doesn't change unless we purchase another item. Accounts payable was unchanged. B. Clark Capital was unchanged. We're just carrying that number over there. When I do the worksheet, I like to use either a piece of paper or use a ruler or use your name tent to help you carry those numbers all the way across. It gets a little busy and the little spaces are small. So as you're moving those numbers over, that might help. Just a piece of paper would be fine. How far did we get? The withdrawal was unchanged. The word processing fees unchanged. Office salaries expense, we had $1,300. We made an adjustment of $350. Debit and debit, what do we need to do? Add. Okay. Advertising expense, telephone expense, those were unchanged. Now the accounts that are listed down here, they had a zero balance. Now they have a balance. So we need to carry those over: office supplies expense, rent expense, depreciation expense, word processing equipment, accumulated depreciation, word processing equipment, and salaries payable. Carry them over to the appropriate side on that adjusted trial balance. And then once again, add up your debits and credits to make sure that they equal before you go on. Now when you take another accounting class, you might not have that adjusted trial balance columns. In our book, we have that on the worksheet. If you want to do a worksheet in your place of business and you're creating your own form, put that adjusted trial balance in there. It just gives you another opportunity to say, hey, I'm in balance, before you start dividing up the accounts. All right. So there we've got just our reminder, the debit and debit, we're going to add it together. Preparing the income statement and the balance sheet sections on the worksheet. Now this should not be anything new because you've prepared the income statement and the balance sheet since chapter 1. It's just a little bit more complicated. There's a little bit more detail in this one. From the adjusted trial balance, we're going to take each one of those accounts and put it where it belongs. Is it an income statement account or is it a balance sheet account? I like to add up at the top of those two columns for the income statement, ICE. What's the ICE stand for? Income, cost, and expense. You don't have any cost accounts until chapter 11. Income, cost, and expense. That's all that goes on that income statement. The next two columns will be the balance sheet. ALP, assets, liabilities, proprietorship, or owner's equity. If you use the ALO, you might see that E and think, oh, the expenses go over here. No. The expenses don't. Remember, certain accounts are income statement accounts, certain accounts are balance sheet accounts, and that doesn't change. Here's where your ruler or your straight edge, a piece of paper, will help as we're going down and determining where each one of those go. Now, they're only showing us the income statement right there. But if we were starting with cash and putting it where it belongs, where would cash go? To the balance sheet. Where would accounts receivable go? To the balance sheet. Office supplies, balance sheet. Prepaid rent, balance sheet. Word processing equipment, balance sheet. Accounts payable, balance sheet. Capital, balance sheet. And withdrawals, Where does the withdrawals go?
Balance sheet.
It's going to the balance sheet. We're going to eventually subtract it from the capital, but it's still a balance sheet account. It's not an expense account. It's a, starts with a C, contra capital account, okay? Now, when we get down to the next ones, all right, word processing fees, where does it go? To the income statement. Office salaries expense, income statement. Advertising expense, income statement. Telephone expense, income statement. Office supplies expense, rent expense, depreciation expense, word processing equipment. Income statement, the expense should give it away. Accumulated depreciation, word processing. Goes to the balance sheet. What kind of an account is this? Starts with a C, contra asset account. Okay, it goes to the balance sheet. Now it's all the way down at the bottom. So that's the one that you might put on the wrong financial statement. And salaries payable, where does it go? To the balance sheet. I like to start at the top and work my way down. They didn't do that. They're just showing us the income statement. I don't even know that they show us the balance sheet, do they? Did they show us the balance sheet? I don't want to talk about those totals just yet. All right, they do give us the balance sheet. So there's our accounts carried over to the balance sheet. I don't know whether it gives us, oh, it doesn't give us the whole thing. Let's look at the picture in the book. Let's look on page, in my book it's page 132. Is it 132 in your book? All right. And there's an entire worksheet. When we start totaling the worksheet, so far, all of our totals have equaled, haven't they? When we did the trial balance, when we did the adjustments, when we did the adjusted trial balance. When we get over to the income statement and the balance sheet, those columns will not equal. So we'll add the left side of the income statement and the right side of the income statement. On the balance sheet, we'll add the left side of the balance sheet and the right side of the balance sheet. When we subtract the differences between those two columns on the income statement and the balance sheet, that number should be the same. If you look at that picture, they've subtracted the smaller number from the larger number. What does that number represent? Look over to the left. Our net income or our net loss.
Look out in the middle.
You're going to put the answer there. Now, when you look at the totals, and I want to draw an illustration up here. And then I'm going to give you a mnemonic. All right, so we have the debit and the credit, and the debit and the credit. Okay, so we add those up, and those numbers do not equal. So we have a total here, a total here, a total here, and a total here. When we subtract the smaller number from the larger number, we should get the same number on the income statement columns and the balance sheet columns, and that will equal our net income or net loss. If our revenue is greater than our expenses, we have a net income. If our expenses are greater than our revenue, we have a net loss. So we have our number here, 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 and here. The difference between those columns, we want to add it to the smaller total. So on your example, you had a net income, didn't you? So we're adding the difference here and here. Now when we add this number to the debit side of the income statement and the credit side of the balance sheet, those numbers equal, don't they? So these two are the same and these two are the same. Now how are you going to remember that? Here's the best way to remember, and the people at home probably need to see me do this. If we have a net income, we're going to put the totals, or the difference between those columns, on the outside two columns. How big do we want net income to be? Huge, don't we? If we have a net loss, we're going to put those numbers on the inside two columns. So instead of being here and here, they're going to be here and here. How big do we want the net loss to be? Small. Okay? Net income, the outside two columns. Net income, the inside, or net loss, the inside two columns. Net income, the outside two columns. Net loss, the inside two columns. Now on your test, I may say, if you're adding your difference between the columns on the income statement, on the credit side of the income statement and the debit side of the balance sheet, do you have a net income or net loss? Net loss. If you're adding the difference to the debit side of the income statement and the credit side of the balance sheet, do you have a net income or a net loss? A net income. You can figure that out based on my story, my big fish story. The big net income story, we want it huge, and we want the net loss to be small. I think that's the easiest way to remember where it goes and whether it's a net income or a net loss. Sometimes the sillier the things are to help you just trigger something up here in your brain, because we can put lots of stuff up here, but if you can't recall it, it's not going to do any good. So you'll remember my story. Net loss, net income. And that's on the worksheet. And we always want to add the difference. So it will go from side to side, whether we have a net income or a net loss. Now when we look at that picture in the book, and you can look at part of this, you can see that we have a single line here, and that we have a double line down below. Make sure those double lines go from the beginning of the column to the end of the column. And if you look at that picture on page 132, we can see that those single lines go all the way across, and then the double line goes all the way across the last four columns. You can wait and do those lines when you're finished with the worksheet if you want to, or you can draw those lines as you complete each column. The only thing that's labeled over at the left is the net income or the net loss. Okay, net income or net loss. We don't have to write the word total. We'll just do the net income or net loss. From here, now we can prepare the financial statements. Now in chapter 5, we have to do some journal entries, because even though we've adjusted 8 accounts, are they current in the ledger? We adjusted them on the worksheet, but we didn't adjust them to the ledger. So in chapter 5, we will record those adjusting entries in the journal, and then we'll post them to make those accounts current. From the worksheet, we can prepare the financial statements. And hopefully we've added everything correctly. If we have a mistake, we'll have to go back and try to figure out what we did. Your totals on your worksheet can actually come out, and you can still have the numbers on your wall. If you did your adjustment incorrectly, use the wrong figure, your totals will still come out. So you've got to check those. So when we prepare the income statement, we're just going to take those numbers from the worksheet and prepare the income statement. Every figure on the formal statement is on the worksheet. No debit or credit columns appear on the formal statement. We have to do any calculating. We'll move it over to the left to do the calculating in the column to the left. Withdrawals do not go on the income statement. They will go on the statement of owner's equity. Jennifer.
You said that the withdrawals actually on the balance.
On the worksheet they do. Because we didn't prepare the statement of owner's equity yet.
Oh, because that's on the worksheet.
Mm-hmm. And it will have the opposite balance of the capital, so it will actually be subtracted from the capital, so they offset each other. But on the worksheet, we'll carry it over to the balance sheet. Because it's not an expense. The withdrawal is not an expense. It's a contra capital account. And the capital goes where? On the balance sheet.
Why don't the financial statement have that?
They just don't.
That was a question, discussion.
Right.
And I was like,
They
they
don't.
just don't.
They don't, because we just have our totals. On the right column of the financial statement will be our totals. If we have to calculate something to get that total, like listing all of our expenses, we'll list those to the left and then add them up and carry the total over to the right. I think we have some pictures of the financial statements on the rest of the page, so let's look at those. Preparing the statement of owner's equity. Remember, the statement of owner's equity gives us our ending capital or the beginning capital for the next fiscal period. It would be the beginning capital plus the net income or minus the net loss, minus the withdrawal. If we had an additional investment, we would have to add that. And that will give us our ending capital for the current fiscal period, but it will be the beginning capital for the next fiscal period. Preparing the balance sheet. Remember that the totals on the worksheet do not match the totals on the balance sheet. Information is grouped differently on that formal statement because we would not have the withdrawal. Accumulated depreciation is subtracted from the equipment, and the withdrawals are subtracted from the owner's equity. Oh, I guess we don't have a picture of what those financial statements look like. So let's look at one from our book. Maybe, if I could get the light to come on. There. There's a good picture of what the completed worksheet looks like. A little blurry, but that's the one that's in your book. This is the part that you might have some trouble with just making this to appear neatly, I guess, on the piece of paper. So your single line to indicate that you added and subtracted, your single line here because we are adding here, and then our double lines. This is the only line that needs to have a description, and this would be your net income or net loss. If we couldn't see it over there, how would we know that was a net income? Outside your columns. And if we had the numbers right here, would be a net loss. And we want that to be small. So let's look at the financial statements. Just a review of what the income statement would look like. This is for J-Trip. This is one of our exercises. Notice the heading, the company, the financial statement, and then what the fiscal period was. We'll list our revenue first. Here's where we're going to move things to the left column. It's just to list those and add them up. Carry the total over here. This right column, instead of it being debit and credit, is just for our totals. And here we had a net income. I don't see the double line there, but there should be a double line right there. The statement of owner's equity, it doesn't change from what we've been doing. Beginning capital, we had a net income on this one. We had withdrawals, and remember, if we're subtracting something in accounting, we usually put it in parentheses. And here we had a decrease in capital, and again, it's in parentheses. Our dollar sign, and then we should have a double line down there. And our last statement is going to be our balance sheet. This is the only one that has a specific date on it. And it's the accounting equation up here at the top. Assets equals liabilities plus the owner's equity. Did everybody get that right on the test? Or did you just draw a blank? Did you remember how to do it on the test?
Yes.
Or did you draw a blank? Okay. You did? And then did the other parts come back to you? They did? Okay. All right. Now. Yeah. I know. Well, and we'll keep doing the income statement, the statement of owner's equity, the balance sheet. We don't ever get away from that. When we do our payroll, when we do bank reconciliation, we're not going to be doing these, so we'll sort of get away from them for a little bit, but we'll always come back to them. So don't think if we're not talking about the income statement, the statement of owner's equity, and the balance sheet that you can forget. No, you can't, because we'll come back to it. It gets a little bit more detail to it as we progress through the chapters. When we get to chapters 11 and 12, if you look ahead, the income statement and the balance sheet has a lot more detail to it than what we're doing in these. How are we with time? I think we could start the demo problem. If you have your envelope, does anybody have theirs? If you don't have your envelope, you can use one of my worksheets today. If you have your envelope, then just pull one out. You need a worksheet now, your envelope. Yes, I always offer extra credit at the end of the semester because I like these pages. I'm the only one I think that uses the legal size paper. So if I can get the worksheets for you, oh, Then Sarah doesn't have to order them. You need one.
On my assignment, it said I didn't get a job but right here.
But it's not, it doesn't go in the discussion for chapter 2, it goes under the questions. That was if you had a question about the chapter 2, got one? You have one?
I turned it in to discussion.
Let's stop.